Bitcoin is back near $77,000. Gold is trading around $4,600 an ounce. The US dollar has weakened. Treasury yields are sitting at levels that are suddenly making investors nervous. And Wall Street just finished a volatile week. So what exactly is going on? Here's the important part. These aren't 5 completely separate stories. Bitcoin, gold, stocks, currencies, and bonds are all reacting to the same bigger question. What happens to liquidity, inflation, interest rates, and confidence in US fiscal policy from here? And this coming week could give us some important answers. Welcome back to Modern Finance. We are covering crypto, stocks, forex, gold, macro, and market intelligence. No hype, no guaranteed predictions, just the information traders need to understand what is actually moving the market. Know the market, move smarter. Let's start with the numbers. Bitcoin finished the week dramatically higher. Bitcoin gained roughly 23% during the week and was trading around the $77,000 area, according to recent market reports. Gold also pushed higher, trading around $4,600 per ounce. And the dollar weakened as investors focused on the US Treasury market and concerns surrounding long-term borrowing costs. Meanwhile, US stocks bounced on Friday. The S&P 500 gained about 0.4%, the Nasdaq gained about 0.4%, and the Dow jumped about 1%. But here's the catch. The weekly picture was still negative. The S&P 500 lost 1.4% for the week. The Nasdaq lost 2.1%, and the Dow lost about 0.8%. So we have a market that looks strong if you only look at Friday, but much less comfortable when you zoom out to the entire week. And that's where bonds become extremely important. Bitcoin is probably the most dramatic part of this story. BTC moved to the high $60,000 earlier in the week toward the upper $70,000. Yahoo Finance's historical data shows Bitcoin reaching an August 21 high above $79,000 before consolidating. That's a huge move. But traders should ask a more important question then. Is Bitcoin going up? Ask, why is Bitcoin going up? Several forces appear to be working together. First, liquidity expectations. Second, a weaker dollar. Third, renewed optimism around US crypto regulation. And fourth, positioning. When a market has been heavily positioned one way and suddenly moves aggressively in the opposite direction, short covering can amplify the move. That's one reason traders shouldn't automatically interpret the sharp rally as proof that the next move must be higher. Momentum and fundamentals are not the same thing. Bitcoin is showing strength, but the question now becomes whether that strength can hold after the initial surge. For traders, the key levels aren't just psychological numbers like $80,000. The bigger question is whether Bitcoin can establish a higher range after the rally rather than immediately giving back the move. Now here's where the story gets interesting. Bitcoin isn't the only asset attracting buyers. Gold has been moving aggressively too. Gold reached approximately $4,607 per ounce on August 21 and was roughly 5% for the week. And according to recent reporting, gold has risen sharply during August while the dollar has weakened. So why are investors buying both Bitcoin and gold? Because they're not necessarily trading them for the same reason. Gold is deeply connected to real yields, inflation expectations, central bank demand, geopolitical risk, and the dollar. Bitcoin has its own unique supply and liquidity dynamics. But there's an important common denominator: confidence in fiat liquidity and the macro policy environment. When investors become concerned about currency debasement, fiscal sustainability, or the future purchasing power of money, assets outside traditional sovereign currency exposure can become more attractive. That doesn't mean Bitcoin is digital gold. It doesn't mean gold is guaranteed to rise. It means the correlation between these markets can tell us something about investor positioning. And right now, that signal is worth watching. Now let's talk about the US dollar. The DXY was around 98.82 on August 21, according to the recent market data, and the dollar had weakened over the previous month. A weaker dollar can matter across almost every market. Why? Because the dollar is the world's dominant reserve currency and many commodities are priced in dollars. When the dollar falls, it can mechanically make dollar-denominated commodities more attractive to holders of other currencies. But there's something even more important happening: the Treasury market. The US government announced that it would increase the size of certain long-term and Treasury buybacks beginning September 9, the maximum size of individual operations in the affected sectors will rise from $2 billion to at least $4 billion. The objective is to provide liquidity support in longer-dated Treasury securities, but investors aren't ignoring the bigger question. Why are long-term yields so high in the first place? This may actually be the most important part of the entire episode. On August 21, the 10-year Treasury yield was around 4.68%, while the 20-year and 30-year yields were around 5.25%. Those numbers matter because long-term Treasury yields influence borrowing costs throughout the economy. Mortgages, corporate borrowing, valuations, technology stocks, government financing, and ultimately risk appetite. Think about it this way: when long-term yields rise substantially, investors can demand a higher return to own risky assets. That creates pressure on high-duration equities, particularly expensive growth stocks. It can also change the relative attractiveness of cash and bonds, and that's why the stock market's reaction this week is important. The indexes bounced Friday, but they still finished the week lower. The bond market remains one of the biggest variable traders need to monitor. And now we arrive at the Federal Reserve. The FED kept the federal funds target range at 3.50% to 3.75% at its July meeting. The statement said inflation remained elevated relative to the FED's 2% goal. The July meeting was also notable because the decision was not anonymous. The FED's minutes showed that policymakers were still balancing inflation risks against the outlook for economic activity. That means traders are watching every piece of incoming data, and this week gives them a lot to watch. On August 26, the U.S. Bureau of Economic Analysis is scheduled to release July personal income and outlays data. That includes the PCE inflation report. The previous June PCE data showed headline PCE rising 3.7% year over year, while the core measure is closely monitored by the FED. The July report therefore matters because it can influence expectations around future monetary policy. If inflation comes in hotter than expected, markets could resist the path of the rate cuts. If inflation comes in softer, expectations for easier policy could strengthen. And because rates affect the dollar, bonds, and equities, the reaction could spread across multiple markets. Then there's Nvidia. Nvidia is scheduled to report its second quarter fiscal 2027 financial results on August 26 at 2 p.m. Pacific time. This is much bigger than one company's earnings. Nvidia has become one of the market's most important AI bellwethers. Investors will be watching revenue, data center growth, margins, AI demand, forward guidance, and the company's ability to maintain the extraordinary growth expectations already embedded in its valuation. Remember, a company can report excellent results and still see its stock fall. Why? Because markets trade expectations, not just numbers. If investors expect spectacular growth and the company delivers merely excellent growth, the stock can still react negatively. That's why Nvidia is one of the most important events on this week's market calendar. So let's build the market map. There are three broad scenarios. Scenario 1, cooling inflation. If inflation data comes in softer, Treasury yields could ease. That could support rate-sensitive equities and potentially risk assets. Bitcoin could benefit if liquidity expectations improve. Scenario 2, persistent inflation. If inflation remains sticky, yields could stay elevated. That could pressure high-duration equities. The dollar could receive support, and markets could become more selective. Scenario 3, inflation plus fiscal stress. This is the complicated scenario. If investors remain concerned about government borrowing, long-term yields could remain elevated even if short-term rate expectations move lower. That creates a strange environment. The FED could potentially become more accommodative, while long-term yields remain high, and that divergence is something traders need to understand. So here's the big picture. Bitcoin, strong rebound, but now the market needs confirmation. Gold, strong momentum and benefiting from dollar and macro concerns. Dollar, weaker recently, with traders watching Treasury yields and FED expectations. Stocks, still positive for the year, but coming off a negative week. Bonds, potentially the most important important market of all. FED still dealing with inflation above target. And the calendar? Extremely important. PCE, Nvidia, Jackson Hole, Treasury policy, and geopolitical developments. That's a lot of potential volatility packed into 1 week. The biggest mistake traders can make right now is looking at one chart in isolation. Bitcoin doesn't exist in isolation. Gold doesn't exist in isolation. Stocks don't exist in isolation. The dollar doesn't exist in isolation. They're all connected through liquidity, rates, inflation, growth, and risk. So don't ask what's going up. Ask what's driving the move. That's the difference between watching markets and understanding them. This is the return of modern finance. Financial news, market intelligence, crypto, stocks, forex, gold, macro, no hype, no guaranteed predictions. Just the information you need to make sense of the market. Know the market, move smarter. I'll see you in the next one.